Good afternoon. Thank you for joining us today on another Barometer Readings. David Burrows is traveling for the next 2 weeks, so James and I will be hosting this webcast with an eye towards updating you on what we see in the market and how we're navigating the portfolios as a result. My name is Diana Victor, and I'm the head of trading and portfolio manager at Barometer Capital. James Callahan is portfolio manager of our equity product, and he will be speaking to you a bit later about how we're navigating the portfolios in these volatile times. We woke up yesterday morning to an unexpected de-escalation of tariffs with China. I almost felt like everything I prepared for this presentation should probably be changed, and I should do another set of pictures and a whole new narrative. But this is the tenor of the market, changing every day, or has the potential to. Not that we didn't expect something over the weekend. We knew that Trump administration and Chinese administration were meeting, but we didn't expect this kind of de-escalation. 145% tariffs might as well have been 14,000% tariffs. Neither was conducive to trade, so we knew something had to break. So the market expected some de-escalation, and most of the people I speak to said tariffs will likely go down to 80%, and the more bullish ones said 60%. But what we got was the baseline 10% that is in place for everyone, plus the 20% fentanyl tariffs that only China has. As a result, market rallied really hard yesterday, and main US indices rallied through their technical resistance and now are above 200-day moving averages. There's a saying that says, quote, nothing good happens under the 200-day moving averages, but now we are above it. So what now? Let's step back for a moment and take a 1,000-foot view, and I'll share with you some of the setups, and then afterwards, like I said, James will take us through the portfolios. So stepping back for a moment, this sell-off has been sharper than the average correction in the last 100 years. The blue line represents the average correction, and the light blue line is the average bear market. Orange is current. You can see that it has been a lot deeper and a lot faster. And maybe that is the characteristic of a Trump administration or 2025, or this is just how it is now after COVID, when there are so many more participants in the market are able to trade electronically and move markets in a faster way. At some point in April, NASDAQ and the S&P were down a lot and underperforming other global markets. Everybody's talking about US exceptionalism gone, finished. The last couple of decades has seen US flows or North American flows have been much higher than anywhere else. Stock fell on the second day after tariff retaliation from China and the signal that the Fed will not be coming to the rescue, which is a point of pain for Trump every time any opportunity he gets. He jabs at Fed Chair Powell for him to cut rates like all the other central bankers so far. The indices at this point fell 10.5% in 2 days, largest 2-day drop in 5 years. NASDAQ 2-day drop brought it down 11.5%, and the index was in bear market territory, down over 22% from its high in February. Secretary of State Marco Rubio in Brussels acknowledged markets are crashing, he said, but that was the necessary result to achieve a broader plan. The average stock fell about 30% off the 52-week high, with some sectors like the technology sector down 40% or more from their 52-week high. And all this was due to the economic policy uncertainty. Companies can figure out almost anything, so can people, as long as there is the rules of the game, as long as there's stability, as long as they know what they're dealing with, they can account for it. But when there is policy uncertainty and back and forth, that really does something to business and consumer confidence and business investment, capital spending, and hiring plans. And we know that employment is a very important tenet of the growth in the economy. The stock market has been democratized in the last couple of decades. No longer is it only for the rich. US households have 30% of their total assets in equities. This really does matter. During this sell-off period, the market saw some of the largest notional global selling on record, driven by short sales and to a lesser extent, long sales. I remember another time like this in 2022, when central banks were raising rates after a generation of zero or close to zero rates at the highest pace ever to combat 9% inflation numbers coming out of the supply chain constraints due to COVID. At that time as well, if you recall, everyone was on the same side of the boat, that a deep recession was for sure coming. That inflation was, of course, tamed, and the core PCE inflation currently is sub 3%. Now, exactly 1 month after the White House surprising decision to pause its week-old reciprocal tariffs or month-old reciprocal tariffs, the S&P 500 now sits 835 points higher than it was at its recent low seen back on April 7th, more like almost 20% higher than the lows. VIX, Volatility Index, is the index that people refer to as the measure of fear, has declined from almost 60 in the beginning of April to just around 18 as of this morning. So are we out of the woods? Container bookings from China have fallen sharply. Like I said, 145% or 14,000% tariffs. It's all the same. There's not going to be any trade. All bad. Will this now change? We hope so, but we will watch this data point pretty carefully. Just to give context to things on talking about container ships leaving China, the previous chart showed a large decline, but the context is that there has been some front loading ahead of the expected tariffs, and the stoppage has taken it to a bit below average. No doubt pricing will be affected, and now perhaps not as much as before, but companies do figure it out. They just need certainty. We still don't have perfect certainty. We may never have with the Trump administration, but it's certainly better than before. In the meantime, business optimism has turned sharply negative. Now, this is what we call soft data. Soft data refers to sentiment. You are a business owner and someone asks you, how do you feel about things? And you say, well, not so good. But do you actually do anything differently yet? Have you been forced to do anything differently yet? The hard data is not showing that they actually have, but sentiment is definitely not good. So what about earnings? We've just finished the earnings reports for the quarter of last. Overall, 90% of the companies in the S&P 500 have reported actual results. These companies, 78% have reported EPS above estimates, which is above the 5-year average of 77%. In aggregate, companies are reporting earnings that are considerably better than expected. And even though they have been better, they were being discounted as backward looking. Expectations were for a 6% growth, and earnings tracked a growth of over 12%. Not too bad. But is it backward looking? The 17% rally that we've seen since lows probably reflects that enhanced growth of earnings relative to expectations, and it is priced in, I think. What we are pricing in now is the de-escalation of tariffs with China, which is a big deal. We're probably due for a pause here. Uncertainty is still high, but not the highest, and is likely to continue to be during all of Trump's administration. So better get used to it. But technicals are definitely trying to be better in the US. Global charts are still excellent. These are interesting times and not at all normal, although during Trump's first term, tariffs featured as well, though not as boldly. But the first year of presidential cycle is ambiguous and difficult, and this chart shows that it is sort of normal. So we'll just see if it continues and try to look forward to 2026. So what are the expectations next year for earnings? Well, they're actually quite solid still. 7%, 7%, 10%, and 9% for the 4 quarters for 2026. These numbers will move around as we get closer. Analysts increase expectations, decrease expectations, but currently they're not even close to being negative, like in 2022, for example. Despite okay earnings expectations, companies are mentioning recessions in their quarterly earnings calls a lot. Everyone is thinking about this, understandably. Just remember 2022 and try to think in a balanced way is how we think about things. Um, usually, everybody goes to one side of the boat, analysts, strategists, media. That's all you hear about. And then the market prices in the worst, just like it did. And then something on the margin is better. So because of this fear of recession, as a result, the difference between gross longs and net longs is very big. It's usually not this large. As you can see, the difference is never this large. Net leverage is just investments minus shorts. This differential will likely close. So we've seen some short covering already. We'll be watching flows closely on this front as it is one of the more supportive flows in the market currently. Along the same vein, institutional positioning is likewise low, same as their hedge fund brothers and sisters, especially in the US, as the end of US exceptionalism trade has been very popular in the last 6 weeks. A Bank of America survey found that fund managers were a net 38% underweight US stocks, the most in 2 years, and exposure to the dollar was the lowest since 2006. Flows have really favored the US for more than a decade. I'm not sure what will happen with Trump's tariffs at the end, or with him backpedaling and everything. Even if tariffs remain higher than before, the wealth effect will likely be minimal if it stays where it is currently. If tariffs stay at around 10%, um, companies can figure that out. But what it also did that we cannot underestimate is that it galvanized and catalyzed the rest of the world. Now, the rest of the world, trading cheaper and for good reason, is now a lot more investable than before. And in our opinion, if you didn't diversify, now is the time to diversify portfolios. I will end with a final market chart from Strategas, in which we can see the speed and depth of the recent 2-month volatility, and that technically it is possible that this market is pricing in a normalized earnings environment after all, with tariffs that may not hit the economy as much as originally thought, but that finally global diversification in portfolio has finally become a more popular thought. And on this note, I'd like to bring on James Callahan, portfolio manager. James, would you please take us through the portfolios?
Of course. Thanks, Diana. And hello, everyone. I'm just going to take over my screen share here. That'll just take a second. I think we're good. So it's nice to see some familiar names on the attendee list, and it's always good to join these calls and to give some insight on what's going on in the portfolios. Diana's done a great job of explaining the macro and the setup here. Over the last few weeks, as we've seen many of the indicators we watch for get more positive, we've wanted to increase equity exposure first to global stocks and then to US stocks because at the time we owned so few. I'll say the obvious, the president has chosen to create an environment of maximum uncertainty. We've really been in uncharted territory, and honestly, and I know we've said so on these calls, a V bottom was extremely low probability outcome here. But as time passes, as we now see semblances of trade deals coming together, it seems like we may have seen peak tariff at this point. Market having put a V bottom in seems much more likely than it did last month. So we're comfortable having a bit more equity exposure at this point because we've really been in capital preservation mode since mid-February. And that's been the right call given the environment that we've been in. We've had the defense on the field. It does seem like it's time to start warming up some of the offensive players. So I'll be the first to make recognition of the fact that in the past, there have been times we've been a bit too quick to flip positive on markets. That's something we're aware of and we're trying to avoid, which is why we've taken a measured approach to layering on new exposure over the last few weeks. It's not our intention to go fully invested yet, but we have reduced our cash weight and we have begun deploying some capital. So as we sit right now, just to give some levels, in our equity mandates, we have about 20% cash and T-bills, down from almost 50% at peak. In our income mandates, we have about 15% cash and T-bills, in addition to some more defensive equity exposures. And on our balance mandate, we have about a 40% corporate bond weight. And those corporate bonds have been performing quite well. So Diana mentioned some of this, but I'm just going to double back to recap U.S. earnings, since we're now more than 90% of the way through the earnings period for the S&P 500. So this slide shows the percentage beat over analyst expectations across the entire index, and then by sector as well. So we saw revenue come in 80 basis points higher than expected. We saw earnings come in about 8.5% higher than expected. And that's against growth numbers. That's against revenue growth of just over 4% and earnings growth of just over 12%. So US companies are healthy. While guidance was a bit of a toss-up for Q2, when you take the lens back, you do see positive earnings revisions going forward. So the situation for the average US company is not as bad as it seems. And then Diana ended on this chart, but I want to spend a bit more time on this specific breadth measure. This comes courtesy of our friends at Strategas, in my mind, the best macro research shop. So yesterday we got 58% of the S&P trading above their 20-day high. When this is back tested, as you can see here, and you look at the 3-month forward performance, it comes out pretty favorably versus normal conditions, as does the 6-month forward performance, which is the lower chart on this page. So here are some examples of this indicator triggering in 2015, 2019, and 2020, all strong forward returns. And here are some examples between 2008 and 2013 of this indicator triggering. So it gives us a bit more confidence that we likely have seen lows, and so we're willing to put some money to work now and start to switch to a more offensive posture than we have been really since the middle of February. So this is just a piece of the puzzle. The market's become more constructive day by day and week by week since lows. So as I say, we've added some exposure. Where specifically we've added exposure, we want to cover that on next week's call. Just to build a bit of anticipation here, many of our clients on the call will have already seen some of these phenomenal businesses make their way into portfolios, in some cases make their way back into portfolios, all leading names in leading sectors, and all decisions have been pretty profitable so far, which is nice. But we'll leave that for next week, so be sure to tune in. I'll go now to questions. I'm just going to end the screen share and have a look at the Q&A tab. And I'm not seeing any questions come through. So with that, if you do have any questions, feel free to reach out to myself or Diana. My email is jcallahan at barometercapital.ca. We can send slides as well. It's no problem. But I'll say, thank you, Diana, for your contribution. That was great. Thank you to everyone for watching, and thank you to all of our clients for continued support. And we'll be back next week with more content. So thank you. Take care.